Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Traders recalibrate the path ahead. The bond sell-off pauses as yields hit multi-year highs. Even higher for longer. Jamie Dimon says the world isn't ready for 7% rates, while Neil Kashkari says the Fed needs to hike again. And as negotiations near a deal to avoid a U.S. shutdown, President Biden joins the UAW picket line in Michigan. Danny, good morning. The question is, have the bond vigilantes been reawakened to the extent they can do more serious damage to the equity rally that you've had for 2023? If you're going into the back quarter and you've already achieved a delivery on your portfolio, should you take risk off the table? There's a deleveraging going on. Stocks are lower across the board from the Americas through to Europe. Goldman Sachs Prime Brokerage tell us that hedge funds are cutting their leverage at the fastest pace since the 2020 crash. It was the unseating. It was the almost skirmish. It's a vertical move in bonds. It's not vigilanteism. So you are seeing this spike higher to 16-year highs in the bond market. You'll talk more about that. That is unseating the overall risk narrative. Morgan Stanley's clients are shorting tech and AI. And Europe comes lower. Bottom of your screen, by the way, is the miners. They are down 0.25% this morning. The basic resources component are still worried about China. Iron ore is down. China is under pressure. That is the malevolent backbone to the European story. Basic resources are down 14% year to date. Europe is on the back foot this morning as Morgan Stanley cut the luxury sector. The profits there, Danny, slashed by between 2 to 5%. So we'll keep an eye on the U.S. translation to the likes of Tiffany, etc., here on the street this morning. Danny.
And Manus, the moves are creating superlatives across the board, and it's telling that finally oil has started to crack. The cuts coming from Saudi and Russia had been the dominating story. Yesterday, at this time, oil was still moving higher despite the risk off. It's unable to do so now. Brent crude down 1%, and a lot of that has to do with the stronger dollar. Here's one of the superlatives at the highest of the year, highest level for the Bloomberg Dollar Index in 10 years. Westpac, Manus, you pointed this out to me, Westpac saying that the other international currencies are unable to fight the exceptionalism of the U.S. dollar. No one wants to fight that macro theme. We are having some of the bond bulls willing to peek their head out today, not by a lot. We're lower by about 1.5 basis points on the 10-year. We're still at, let's call it 4.5%. We're at the highest in 16 years. That's for the 10-year. The 30-year, Manus, that's at its highest in 11 years. Let's flip it up. Let me show you what the 530 is doing, because we are seeing this disinversion, this very rare bear steepening. 530s, that's back above zero for the first time since August. 210s, Manus, that is the thinnest since May. Again, this is rare. It's usually something that happens in a more benign economic outlook. Is it benign now? We're worried about the consumer. A lot of questions, Manus, about what exactly is driving the bear steepening.
Well, in part, it's got to be something to do with the inflation narrative. There is that higher for longer. But if you look at what Jamie Dimon said overnight, which sort of is a tailwind to everything else, we are ready for 5%. We're living with 5%, 5.25%, 5.5%. Nobody has got the lexicon of 7%. Nobody's got that in their psyche. Bonds, global bonds, by the way, Danny, the worst month of 2023. We've lost nearly 3% on the global bond market. And if Jamie Dimon is in any way correct and the trajectory of rates goes to 7%, you can kiss your sweet goodbye to a soft landing. Let's take that thought to our guest this morning. It's Anastasia Amoroso, Chief Investment Strategist at iCapital. So Jamie Dimon, puts the cat amongst the pigeons in terms of flying kites about 7% rates. In other words, we'll see who's naked, to quote Warren Buffett, who's wearing no shorts when the tide goes out. There you go. If they're going to have to lower volumes and higher rates, there will be stress in the system, and I'm not sure the world is prepared for 7%. What would it take to invoke the wrath of 6.5 to 7% rates? Could they? Would they? Anastasia, good morning.
Good morning. Well, first of all, 7% is, that's still not anybody's baseline scenario. But I think it is right to be talking about, with rates at 5.5%, potentially going higher, who are the vulnerable parties across the table. And so it is the right time to be doing some of those calculations. And we're very carefully digging into the health of the consumer, the health of the corporate balance sheets, the health of the commercial real estate. And when we do that assessment, Manus, what I'll tell you, at least looking at the U.S. consumer, only about 11% of the consumer liabilities in the United States are floating rate. So the rest of them are fixed. So even if rates were to go to 7%, it's not an immediate reset across the board for the consumer. The other thing I will say for the U.S. corporates, for example, looking at the S&P 500, only 8% of the debt is floating rate. So once again, it's not a wholesale reset that would leave everybody vulnerable. Now, clearly, commercial real estate is something to worry about. And there's $1 trillion or $1.5 trillion, depending on what time span you look at, of upcoming maturities. And there's certainly going to be difficulties there. But is it the same size of the loans that we had during the great financial crisis and residential mortgages? The answer is no. So I agree there will be pockets of distress, but I don't think it's a wholesale impact to the broader economy.
So if it's not a wholesale impact, there is still resiliency out there, be it for corporate balance sheets or the consumer. Does it make sense to you then to see the long end selling off? Is this a trend you'd want to chase after?
Look, it does make a lot of sense. And I know you were talking about what's the reason for this bearish steepening. And I think there's several reasons why the long end rates are backing up. First of all, is we have high for longer rates of 5.5%. So we had to reprice for that. And this feeling, had to sink in. And I think that's part of that. The second part is inflation expectations maybe crept up a little bit, and that impacted the long end as well. But there's also a good component to the backup in yields as well. And that is the fact that growth expectations are pointing higher. So if you're in the soft landing camp, you should be in the curve re-steepening camp as well. So it makes a lot of sense to me. And then, of course, it's the upcoming increase in Treasury issuance for next year as well. So, I'm not necessarily pounding the table and saying buy long duration here. But I do think, given how much the yields have backed up, I think we are due for a pause on long end.
And I like the way you frame it there, which is, to you, is logical. To a lot of people, they were scratching their heads yesterday in terms of this curve steepener. Was it about inflation, or was it about supply, or was it about growth? You say that 4.5% on Treasury yields is a return to normal. And with that in mind, and again, this goes back to decades ago. It's 16 years ago when we last had rates at this level. So the question is, do you buy the belly of the curve here? Danny was talking about the steepener there that you saw, which is back in the positive zone. If you want to take duration in this normal zone, as you call it, is it 5s or 10s, or where do you take it?
Yeah, I mean, I don't know if this is a great time to be taking duration risk, because, Manis, the reason I would want to buy, let's say, the long end Treasury is if I believe the recession was coming, it was imminent, and I don't think we're there quite yet. So, and in the meantime, you have this, growth risk and also issuance risk. So if I were to buy anything along the curve, I would look to some of the shorter duration Treasuries, because you're not going to have the same mark-to-market volatility in those, even if rates do move a little bit higher. And I think we, at this point, should probably believe the Fed that they're close to done. So if it's another 25 basis points, I think the curve is appropriately priced for that. So I would stick with some of the shorter term maturities for that.
Yeah. Just on supply, this week alone, 134 billion of Treasury auctions, about 20 billion of corporate bond sales this week. Sure, growth looks good, but you have supply, you have higher oil, you have strikes, you have all these things that are out of the Fed's hands. Do you worry about shocks? I mean, almost 5 different possible shocks that could hit this economy.
You're right. You have 5 mini shocks, I would call it, to the economy that are sort of all piling on top of one another. And there's 2 ways to look at it. First, it is negative for potential GDP growth in the fourth quarter. And, that means a growth slowdown and maybe stocks don't do well. But if growth does slow down, but it doesn't turn negative, which is my base case, then maybe this move higher in yields actually pauses. And if that's the case, then that's a positive for stocks, and that could support the valuation of tech stocks. And I think, Danny, that's what happens, because, third quarter was a bit of an anomaly. Everything worked in terms of growth momentum, but now you've got the auto worker strikes in the United States. You've got the potential, hopefully we'll avert that, a government shutdown. You've got the oil shock that's going to take some wind out of the consumption sales. So all of that means slower GDP. But I think the yield higher in rates pauses, and I want to be buying the spikes in rates, and I want to be buying the dips in tech for that.
You can hop off for a bit of lunch with Bob Michael, who wants to buy every dip in terms of these bond prices and the spikes in yields. Can I circle back to your thought process on the consumer? I get it. What proportion is floating, what proportion is fixed, and how injurious would an ever higher Fed be? But if I look at the savings rate, and this talks to, we put it into the GTV library, this is the savings rate in the United States of America, and it is the piggy bank getting smaller, and only 20% of only the richest 20% of Americans have excess savings. And that's ultimately about the end of COVID and the drying up of a great deal of the momentum in this economy. Should I be concerned about the piggy bank getting smaller?
Well, yes, in a way, because it does mean slower consumption in the quarters ahead, but that doesn't mean that the whole consumption story falls apart. I would say that excess savings was only one part of why consumer has been this strong, and we know that's starting to get tapped out. But what I also look to, Manis, is the fact that the unemployment rate in the United States is 3.8%. And as long as a person has a job and he or she is getting paid more for that job, I think that propensity to spend is still going to be there. But having said that, having fewer excess savings, that's a negative. Also, the fact that oil prices are up and gasoline prices are up close to 20% this year, that's also going to diminish, some consumption. So I would say slowing, but not derailing in the U.S. consumer story.
Okay, well, hold that thought. We've got a little bit more work to do, and we'll talk more about the oil markets. Anastasia Amoroso, our guest this morning, setting the tone for risk as President Biden heads to Michigan to join the UAW strikers. More on that story ahead. And we'll catch up with Rob Arnott, chairman of research affiliates, on, you got it, Danny's favorite, value versus growth, coming up later this hour, right here on Bloomberg Brief.
Welcome back to Bloomberg Brief. I'm Danny Berger in London. Manis Cranny is in New York. Now, we've finally seen some cracks in oil today. It's down about 1%, whether you're looking at WTI or Brent crude. Even so, it has been rallying. These cuts coming from both Russia and Saudi. The calls are growing for $100 a barrel oil. Anastasia Amoroso is still with us, Chief Investment Strategist at iCapital. Anastasia, I know one of your calls is to go long energy. We're in this world where JP Morgan, not just calling for $100 a barrel, but an oil super cycle. Is that coming? Is that what's in store?
I mean, look, there's a lot of good arguments for it. And one of those arguments is that it's very clear that OPEC and Saudi Arabia is very intent on bringing the level of global inventories down. And if they do that, that sets up this elevated oil price environment. And so as long as oil is somewhere between $70 and $90 a barrel, that's where you need to be in order to incentivize additional investment in oil. So, I think the reason why some are calling for the super cycle is because we've been short on investments in oil and gas. And as a result, there's quite a shortage there. So I'm in the camp that oil continues to stay around these levels because I think there's too many stakeholders that are trying to keep it in that range.
Yeah, I mean, Prince Abdulaziz bin Salman himself said, look, we're trying not to go back to the 1980s, but they're going to be darned happy in the 90s. Translate that macro oil move into the equity market for me, because traditionally what we've seen is sort of super buybacks and jumbo dividends, haven't we, within the oil sector? How much do dividends and buybacks matter, if in that sector, or for you going forward for next year?
Yeah, I think that's one of the other attractive reasons to be in oil and gas. If you think about it, and by the way, that's another argument for the super cycle. If you think about what oil and gas companies are prioritizing, they're prioritizing returns to their shareholders in terms of dividends, in terms of buybacks. And if you look at either the cash flow yield or sort of the all-in, cash return to shareholders, it's quite elevated for energy stocks. So that's one reason to like energy. But again, the other is as long as oil prices are 90 or maybe $100 a barrel and the break-evens are 50, let's say they creep back up to 70, that still gives those oil and gas companies a lot of cushion to have the profitability, to have the earnings growth, and also to return some of that cash. So, I personally like staying long energy because, look, we think inflation, is headed back down to 2%, but in the event that it's not, in an event that we have too high of demand and not enough supply of oil, I want to continue to have an inflation hedge. And so that's why I think part of the barbell of equity investment is energy.
And then the other side of that you were saying is tech.
Yes.
There's not duration risk there, though. If yields are marching higher or they stay around these levels, can I still really be buying tech?
Well, tactically speaking, I do think there's room for yields to pause, given the economic slowdown that we're likely going to see in the fourth quarter. But, looking through beyond that, of course, higher rates is one piece of the story. They dent tech valuations. But let's think about the top line and let's think about the earnings growth. And what we know is tech is likely to deliver double the earnings growth of the S&P 500. And the other thing, what we have to do in this environment of return back to normal of, 5% rates, we have to reduce leverage and we have to look for companies that are not over levered. And guess what? That's the tech stocks. If I look at the net debt to EBITDA for all the sectors of the S&P, it is lowest for information technology. So you don't have a whole lot of fundamental detractors from higher rates there.
Let's just close off with your thoughts on risk. I started the show talking about leverage. The prime brokerage give us their notes every couple of weeks. Goldman's, hedge funds cutting their leverage at the fastest pace since the 2020 crash. There's a loss of sponsorship from the retail market. Morgan Stanley, actually, they're taking the other side of your trade. They're shorting AI and tech at the moment, so that there'll be some rich offers for you to pick off. But when you look at what happened last week, some people say it was a risk parity week, bonds, stocks, and equities all on the downside. Do you think we're at the start of a new cyclical dip, or is it contained? Are we going to pull back from these highs in the yields? Do you think that run is done?
Yeah, I think the technicals deterioration is maybe in the last few innings, and we've been seeing it for the last month and a half or so. I mean, if I kind of rewind back to the beginning of August, you had systematic traders that were very long equities. You had hedge funds that were sort of in the 80th, 90th percentile of net longs over the last year or so. So you had a lot of people into the long trade. But now the exact is happening in reverse, and you've got systematic traders that have reduced their positions. As you mentioned, hedge funds have put on the shorts. But guess what? As a result, that's up a contrarian bullish setup. Mm-hmm. And by the way, both the S&P and the NASDAQ are sort of approaching these oversold levels. So I think we may still see some technicals deterioration over the next week or so, because the biggest buyer in the market is not in the market right now, and that is the corporate buyback. So the window is going to be shut by the end of the week as we get into the earnings season. But once we come back from that, gradually throughout October, I think the technical will improve.
Right. Anastasia, thanks so much for joining us. I'm afraid that's all we have time for. Thanks for stopping by on your Europe tour. That's iCapital's Anastasia Amoroso. All right, quick check on markets as we head to break. Some of that technical breakdown still happening. Down 0.5% on S&P 500 futures. Dollar year-to-date highs. 10-year getting a bid, but still at 4.5%. As crude drops by about 1%. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, Manus, Republican and Democrat negotiators in the Senate are said to be nearing a deal on a short-term spending measure that would keep the government open until October 1st. Now, that legislation would extend funding for 4 to 6 weeks. It is a shorter time frame, though, than Democrats wanted. A U.S. shutdown would be negative for its credit rating. Moody's warned the only major grader to still have a top rating for the U.S. country, Manus.
Well, at the same time, we've got President Biden moving to join the UAW picket line in Michigan. That's today. Bloomberg's Oliver Crook joins us now. Oliver, good to have you with us this morning. I mean, we touched on this yesterday. We've been preparedness to do this. This is history in the making in terms of a president going to the picket lines. Who does this help more? Do you think it emboldens the negotiation for the union, which the White House says that they're not talking about this deal? Or is it Biden's re-election campaign?
I think it has the potential to help both and potentially even hurt both, if you follow me long enough here. But this is, again, as you say, 100 years, there's not precedent for this, of a sitting president to go down and join the picket line. And it comes also critically at a time when public opinion of unions is the highest it's been since 1965. That's according to a recent Gallup poll. So there's the sympathy there. The UAW backed Biden in 2020. They have withheld their endorsement so far. Sean Fain has said Biden really needs to earn this. And the risk for Biden and for the union is that if this drags drags for a very long period of time, starts to inflict economic damage, it might test the sympathies of voters. And of course, Trump is going to be there on Wednesday trying to speak his own agenda, him really pointing to the fact that the EV policy by Biden is really the thing that's killing the auto industry in the U.S. That's a line he's going to push. And really, we have to emphasize how important Michigan, Wisconsin, Pennsylvania are to the re-election. They went Republican in 2016 when Trump won. They went Democrat in 2020. These are absolutely crucial states for this election.
Yes, the Rust Belt swing states. You mentioned the economic damage, Oliver. Obviously, a lot of that has to do with how long these strikes go on for. What is the current thinking there?
So let's look at one dimension of this, because I know that Manis enjoys crook accounting, not quite CPA level. But if you look at one dimension of this, the strike fund, which is $825 million, $500 a week per worker for every week they're on strike, 18,300 workers, that's about $9 million a week. That could take you about 90 weeks at this level, right? That changes, obviously, if they expand the strike and they decide to go all out. But the question is also, will this escalate? There are some signs of that as well. Ford saying that it's going to pause construction on a battery factory in Michigan that would employ 2,500 people. They say it's down to scrutiny over its ties to China because it's a joint partnership with CATL. However, the union taking a rather different view of that. In a tweet overnight, Sean Fain saying, this is a shameful, barely veiled threat by Ford to cut jobs.
Okay, Oliver, as you say, they've got to expand these strikes into the truck division to really have a grinding impact. Well done on getting the tweet in there, right on the edge. Oliver Crook in Berlin on the UAW. Up next, Rob Arnott of Research Affiliates joins Danny and myself with the favorite topic, value versus growth. What's good on Bloomberg? Welcome back to Bloomberg Brief. I'm Manis Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. Traders recalibrate the path ahead. The bond sell-off pauses as yields hit multi-year highs. Even higher for longer. Jamie Dimon says the world isn't ready for 7% rates. Neil Kashkari says the Fed needs to hike again. And as negotiators near a deal to avoid a U.S. shutdown, President Biden joins the UAW picket line in Michigan. Risk is cracking this morning. It's very apparent through oil, which has stayed very heavy. It stayed bid through most of yesterday's sell-off. But today, that is not the case. We're down by about 1% on Brent crude. We're back below $93 a barrel. Part of that story, higher dollar strength, dominating everything. Westpac says that few currencies will resist the resiliency of the U.S. macro theme. Certainly what we're seeing, dollar at a year high. That's, of course, not the only superlative. We have a U.S. 10-year yield. That is at 4.5%. It's getting a little bit of a bid, but the bond bulls, for the most part, are disappearing, down 1 basis point. And Manis, 16 years ago, do you know what was top of the charts? Do you remember?
I know that we actually Googled this, and I actually can't remember what we Googled.
I'll tell everyone, I remember, it's Big Girls Don't Cry by Fergie. Manis, how could you forget that? September 2007, that's what was top of the charts.
September 2007, I think I was sort of caught up in a vortex of sort of post-Lehman crisis at Cantor Fitzgerald, ending my career in equities and going, why am I here? Look, I can't top your superlatives. What I can tell you is this, is that risk got spooked by the spike in yields yesterday. The question is it bond vigilantism round two, or are we pausing for thought? Equities are lower. Leverage is being taken out of the system, both in the US and across in Europe. You've got S&P 500 down 0.5%. Leverage is being slashed at the fastest pace since 2020. That's what Goldman Sachs prime brokerage are telling us. Morgan Stanley's clients are shorting tech and AI. Yet our guest from ICAP, Anastasia Amoroso, just said she wants to be a buyer of these dips in tech. She likes tech because of all of the hallmarks of the balance sheets and the debt structures. Europe is down again this morning, down 0.6%. Bottom of your screen, you've got the basic resources narrative. 24 hours ago, I talked to you about China and Evergrande and a liquidation risk. That is still very alive and very real. Is it contained within China? Either way, iron ore is on the floor. High beta currencies are down. Basic resources are down. Morgan Stanley are cutting luxury stocks profits targets by between 2 and 5%. So we have these renewed levels of pressure, but it's not vigilantism. Danny, good morning.
Good morning, Manis. And amid all of that, We've seen 530s. It's this disinversion that's taken hold. 530s, it's positive again. 2s, 10s, that's the narrowest since May. But it's notable, today it's bull steepening, but for the majority of that, it has been bear steepening. It is something that is very rare. Anastasia Amorosa said that it makes sense to her because not only are we reappraising rates, growth continues to be strong.
Yeah, but in her view, she quite likes the growth narrative. She says that's the reason why we get this pop in rates. She wants to be longer off the shorter end of the curve relative to duration at perhaps 7 and 10s. But adding fuel to this fire is, of course, Minneapolis Fed President Neil Kashkari. Danny, he says that the Fed will need to raise rates one more time this year if the U.S. economy is stronger than expected.
There's a lot of uncertainty about where we are in terms of how tight is monetary policy right now. And so that's why, if you look at the SEP, the forecast, or the projection rather, we have a majority of participants have us raising rates one more time this year. I'm one of those folks who has that. But basically, we're going to take our time, see what happens to inflation before determining how high we need to go.
Kashkari talking about another hike. Diamond talking about not being able to handle 7%. Bond yields march higher. Amid all that, let's bring in our next guest. It's Rob Arnott, chairman and founder of Research Affiliates. Rob, really great to have you in London. Great to have you in the set. How would you describe this current period that we are in? Are we in a readjustment to higher rates in this market and in a different environment for risk?
Of course we are. We are in an environment where we're coming off of a decade of zero rates. Think of interest rates as a speed bump. If there's no speed bump, you get reckless driving. And when it comes to the macroeconomy, you wind up with malinvestment, misallocation of resources, propping up of zombie companies. You wind up with corporate welfare. You wind up with a whole array of ills that take time to heal. When rates get too high, you have a speed bump that stops innovation. And so what we lack is a central bank that's willing to have a steady hand at the tiller, that paints itself into corners one right after the other. Yield curve inversion is known as one of the best predictors of recession. I would argue yield curve inversion doesn't predict recession, it causes recession by inhibiting innovation, inhibiting investment in new ideas. So what we have right now is an inflation-fueled rise in interest rates, which acts against the macroeconomy.
So, Rob, with that in mind, you talk about... Good morning from New York.
Hi.
So the Fed, in your view, has boxed themselves in. Therefore, do I need to countenance what Jamie Dimon has suggested? If they need to take volume out of the system, they may well need to go higher. Is that something that the market just has not been able to even get its head around? It can't get beyond 575.
Well, yeah, the market can't get its head around rates that go to levels that make no sense. The Fed claims to be data dependent. The data that they pay no attention to is the long bond yield, which is set by supply and demand. It's set by the macroeconomy and by the competing views of millions of investors. If you view that as your anchor, why not simply say, under normal conditions, we should keep the short rate a little below the long rate, 0.5% or 1% below the long rate. Australia did that for about 25 years, and Australia has been called the lucky country because it went 30 years without a recession. I think there's no coincidence there. I think recessions are unnecessary, and I know that's a provocative thing to say, and I think central banks often are the proximate cause of recessions when they occur.
That is interesting, this idea that, again, it limits innovation. But I could counter to you and say, Rob, look at this world awash in AI, something I know you follow very closely. There's advancements. They're still spending. Corporate balance sheets are still healthy. What to you says that this curve is creating a recession? Where do you see that happening on the ground? Well,
one of the things about central bank policy is it acts with such a lag. So if the notion is let's raise until there's evident slowing, okay, you've baked in several quarters of slowing by the time you notice the first evidence of it. And so that's one of the key issues. We have a central bank that remember back, well, you won't remember, but back in the Vietnam War, there was a famous colonel who was quoted saying we had to destroy the village in order to save it. Now, if you're a central banker, you have one tool. You can crush demand. Inflation is caused by supply and demand mismatch. If you have supply chain disruptions, if you have people working from home or being paid not to work from home, being paid to simply stay home, if you have people pretending to work from home, all of these things reduce supply of goods and services. If you have airdrops of money into people's accounts, that increases demand. And as a consequence of the supply-demand mismatch, you have inflation. Unless there's a willingness to recognize that policy choices caused inflation, then there's not likely to be policy choices to reverse those causes of inflation.
Well, you talk about the supply and demand argument there, Rob, and undoubtedly the supply side was the COVID angst. Here we are, the helicopter money is done. We've just spent time with ICAP talking about the cracks in the consumer. The savings rate is dropping. The amount of disposable income that Americans have, and indeed around the world, is dropping. Morgan Stanley warned that this fissure can turn into a gusher. Would you agree with that? And how do you position for that if you agree with the thesis?
Well, I do agree with the thesis. I think that we're laying a foundation for relatively high odds of recession, increasing odds of a hard landing, and an unnecessary hard landing. I would love to see a central bank simply take a very patient, steady hand at the tiller approach and anchor on the long rate minus a little. That's not been done. The long rate minus a little would mean you never got to zero. You went from 0 to 2% in one single move. That would have been a step in the right direction. But taking it up from current levels, I think, builds on the risk of a hard landing.
Okay.
Now, you also mentioned that rates don't make sense where they are. What would make sense, Rob?
Well, as I said, long rates minus a little.
Yeah.
So if the long rates are 4.5, if there's long rates are 4.5, why not take the Fed funds rate to 4?
So you think they should be cutting at this point potentially?
I think they should be cutting. Now, all of this has a lot to do with markets and a lot to do with the value growth cycle. One of the things that's happened this year is tumbling inflation expectations on the back of rolling 12-month inflation that keeps getting better and better through June. Well, why was that? First half of last year, we had 6% inflation in the U.S. Second half of last year, we had 0.5%. So that means the first half of the year, this year, we were replacing 1% a month on average. Second half, we're replacing 0.1% a month. So back in January, we predicted that inflation would hit about 3% at mid-year. In fact, our forecast was 2.9, and would snap back to 5.7 by the end of the year. I still think 4.5 to 5.5 is a likely year-end range. That's going to shock people. It shouldn't shock people because all we're dealing with is a base effect.
Right. Hey, Rob, stay put. We have much more to cover. Going to quickly go to a commercial break. That's Rob Arnott, who's sticking with us. This is Bloomberg.
This is Bloomberg Brief. I'm Menace Cranny in New York. Danny Berger at London HQ. Rob Arnott is our guest this morning. Research affiliates talking inflation, talking growth versus value. Rob, you left us with a tantalizing thought, which was we will be in shock, or the markets will be in shock because inflation will be a lot higher than perhaps they anticipate, 4.5 to 5%. Roll that into growth to value, because logic to me is if inflation is in the upper fours, then I don't want to be long growth, do I?
That's exactly right. What we find is that there's a relationship between interest rates and the growth value cycle. It's not a strong relationship. There's a relationship between inflation and the growth value cycle. That one is strong. So when you have inflation expectations tumbling, as we did in the first half of the year, based on an illusion of falling rates, because the comparisons the year earlier were 1% a month, that illusion of tumbling inflation helped to fuel the surge in growth relative to value. Now we're experiencing the reverse of that. Plus, people are starting to ask, okay, is the AI miracle all as miraculous as is commonly perceived? Markets are driven by narratives, and that narrative is starting to get some questions.
That's the thing, though. It's starting to get questions, but are we there yet? I look at ARM, for example, traded below its IPO price, but now it's back above it, $54. I'm going to be honest, Manus and I were talking, and we said to one another, all right, we have to ask Rob, it's below its IPO price. Are we finally there? It's not anymore. It gained again yesterday. I mean, have we finally come to terms about what this means for big tech?
I pay very little attention to day-to-day and week-to-week movements.
Keeps you sane, I'm sure.
Yeah. On a long horizon basis, there's a concept called big market delusion, which was pioneered by Brad Cornell, former professor at Caltech. Big market delusion basically says if there's a brand new concept that people know is going to be big, could be the internet, it could be electric vehicles, it could be AI, the narrative will tend to get ahead of itself. And the narrative embraces the notion that the powerful players in that big market will remain the powerful players 10 years hence. That it ignores the fact that they're competing against one another. It ignores the fact that there are a few winners and a lot of losers in any new big market. It ignores the fact that new competitors come on the scene. And so with big market delusion, you get the creation of bubbles. This reminds me a lot of the internet bubble. The narrative was the internet will change everything. It'll change how we get our news, how we interact with friends and family, how we communicate in business. It'll change how we buy and sell goods and services. And don't worry about earnings because they're coming. That narrative was correct. Narratives are often correct. That narrative was wrong only in the sense that it didn't happen as fast.
Rob, with that in mind, I
expected.
mean, essentially what you're channeling is the Alan Greenspan speech, which was made about the paradigm shift of the internet. And yes, it took a few years to get there. I'm drawn to the one word. I'm trashy, but I want to know where the biggest bubbles are. You know, where's the myth and legend? We've seen some repricing in equities. I put that down to profit taking. We've seen a little bit of a spike in bond yields. I wouldn't call it vigilanteism. So where is the propensity for bubble? Dollars at a year high. Where's the biggest bubble for you outside of AI, or is that the singular biggest risk to markets that it pops?
I think that represents a risk. I think crypto represents a smaller risk. There are, if you look at AI, the narrative's correct. This is going to change everything, but it's going to change everything gradually. And that's the gap that makes the difference. We wrote a paper recently, the AI NVIDIA Singularity, in which we posed the question, is this a breakthrough, a bubble, or both? And to cut to the chase, our view is that it's both.
Yeah. How then, though, if everyone's obsessed with that at this moment, Bank of America in years past have talked about it as the Pavlovian urge to buy big tech. How does value outperform? You say that they're growing, but they're not loved. What changes to make them loved?
The tailwinds for value in the coming couple of years and extending out over very likely the coming decade are very simple. Firstly, it is near record cheapness. It reached an all-time record cheapness by many measures: relative price to book, relative price to sales, relative price to cash flow. Record cheapness relative to growth in the summer of 2020. Now, the narrative that got it there was very plausible narrative that had large doses of truth. It bounced back to test those lows near the end of 2021. It bounced back to test those lows in the summer of 2023. You don't often get a triple bottom. You don't often get a third bite at the apple when something gets abnormally cheap. And then the question is, what would be the catalysts that can allow things to turn? One of them is inflation being stickier, longer lasting than expected. One of them could be higher interest rates, meaning a higher discount rate for the long-term growth of the growth stocks. One of them could be higher instability in the economy. There's no such thing as high but stable inflation. Instability works to the detriment of growth because you wind up having people seeking a margin of safety. They want the underlying earnings. They want the dividends. And in addition to that, you have the risk that the Fed engineers another recession, almost deliberately, and in so doing creates further headwinds and further catalyst for the bursting of a bubble.
Okay, Rob, I'm afraid we're going to have to leave it there. Really wonderful to have you on. Rob Arnott of Research Affiliates, thank you so much.
Thank you so much.
All right, coming up, we're going to take a look at some of the market-moving events to watch throughout the day. And here's a quick check on your markets. S&P down 0.5%. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. All right, let's get you set up for your trading day and what we are watching. President Biden is going to be heading to Michigan. He'll be joining the strike of UAE members on the picket line. Former President Trump is also scheduled to land on Wednesday to host an event with the auto workers. And we are also going to be getting new U.S. home sales. That'll hit at 10 a.m. Eastern. We're going to get some other data, too. That includes the Conference Board consumer confidence data. We are concerned, if you're Morgan Stanley or some Fed surveys, about the consumer. Plus, central bankers speaking this afternoon include ECB Governing Council member Robert Holtzman at 12:30 p.m. and the Fed Governor Michelle Bowman at 1:30 p.m. Manis.
Yeah, well, we just had that conversation with Rob Arnott saying that the Fed has boxed themselves in terms of the ability to do more and that they perhaps shouldn't have got themselves to 5.5%. Some of the big movers this morning, equities are lower, but the prism of risk, I think, is through the FX. Danny, you mentioned it in the market touches, which is the dollar. The dollar's at a 9-month high, and Westpac encapsulated this. We're up for the 5th day in a row on the dollar. She's still holding on to just the green. Westpac say few currencies will resist the bullish US dollar macro resilience theme. It is the best haven if, guess what, Danny? If we shut down. So that is part of the muscular framework for the dollar. And look at the pound. The pound is down. That lunch at the Ivy is getting cheaper and cheaper every day. I just need the airfare to get there.
You still owe me that. I mean, I'm not fighting the U.S. exceptionalism. Manis, you know I've become a British citizen today.
I think we should ring a bell.
I'm tied to that sterling trade. I'm tied to that sterling trade for the rest of my life. Right now, it's not looking so great.
Tell me this, do you like have a pledge of allegiance? I'm sort of getting ready for the American citizenship in 10 years' time. I've just about got a visa to get in here. What do? Pledge the allegiance to King Charles?
I have to. Yes. I literally have to swear my fealty to the king. I don't know, do I have to take up arms? I think I'd look pretty good in a Beefeater hat. So, you know, if I get to do that, sure. Why not?
You pump that out wherever you go. Look, we're talking about Biden going to Michigan, but we've got a line coming through on Tesla.
Yeah.
And this is Tesla's Chinese exports are a target of EU anti-subsidy probe. Now, we've seen price cuts by Tesla literally every couple of months. So this is a new line on Tesla. There you go. This is the pre-market. We're down 1.4% at the moment. It's an interesting kind of punch from the EU, Danny.
Yeah, and we know they've already opened an investigation to different Chinese car manufacturers. So according to people familiar, the aim of this Manis is to what degree China subsidized Tesla and some of those domestic manufacturers like BYD and NIO, and to take any necessary countervailing measures to level that playing field. That is the aim of this probe.
Well, let's see where that goes. I think the other couple of things just to keep an eye on, miners are lower. There's still China angst over Evergrande. So you have a debt woe there. Kit Dukes' note has just come through from SocGen. I think he's been listening in, Danny. He's talking about the bond vigilantes being in charge. That's what happens when you tune into Bloomberg Brief at 5 a.m. in New York. We frame the narrative.
I was going to say, everybody should be tuning in to get a nice narrative. All right, well, that's it for Bloomberg Brief. Surveillance is ahead. Manis, good morning from London.
Good morning. British citizen number one, Danny Berger.